Good morning, Ron.
Morning, Kath.
This is the Baby Boomer Investing Show. Thank you guys for coming on and watching the show. This is season 1. This is episode 8. And today, I guess we're going to be talking about lifespan investing and COVID-19.
Yeah. So this is episode 8. And with COVID now, I think people are getting used to being on their computers and looking at these things. So I think you'll enjoy this. What we're going to do today is integrate several of our previous shows. So this is going to be like a medley of previous shows. And we've been talking about Lifepath investing in the past, off and on. But today we're going to focus on that, and particularly the shockwave that COVID-19 has sent into Lifepath investing. And on the next slide, Kath, let's talk a little bit about what Lifepath investing is.
Okay. There you go.
So it's become very popular in 401k plans, and it's called target date funds. And the idea in Lifepath investing is that unlike what most people do, they meet with their advisor and they develop a plan, and then maybe a year or two from now they develop another plan, and then a year or two from now they develop another plan. Lifepath investing sort of says we all have very similar things that we do through life. We go to school, we get married, we have kids, we start to get retired. But most importantly, in Lifepath investing, you sort of realize that at different times in your life, you have different abilities to take risk. And in particular, the 5 to 10 years before and after you retire are very risk critical. Losing money in what's called that risk zone will ruin the rest of your life, even if the markets recover. So we've been talking about that for several of the episodes. We're going to integrate that today with COVID-19. And you may say, why does COVID-19 matter? Well, obviously it matters, but it matters mostly to older people, and not just their health, which, by the way, we were just talking before the show, that for you people on the call, just to put some numbers to it, if you're in your 80s and you get COVID, the mortality rate is about 15%, so it's high. If you're in your 70s, it's roughly half of that. It goes down to 8%. In your 60s, it's half of that. It goes down to 4%. Then your 50s is around 2%, and then people younger than 50 are almost certain to survive COVID. So it's really a threat to boomers, but the threat there has affected, maybe a few million people. The threat to the economy and to your wealth has affected the whole world. So billions of people are affected financially. So we're going to talk about what COVID does. And on the next slide, our message for basically all of the first 3 baby boomer shows has been consistent. And we'll just repeat it. We're going to say it over and over again, just in case some of you are new viewers. Baby boomers, on the most part, are taking way too much investment risk. And you ought to look at how much risk you're taking, and you shouldn't be surprised to find that you're about 60% in equities, meaning stocks and real estate and things like that. And the 40%, the remaining 40%, much of that is in long-term bonds, which are now pretty risky. So you've been teetering on the edge, and we've been warning you to pull back, to get safe. And if there's an action step in any of our episodes, it's you need to stop taking that much risk. And now what's happened is, I think this COVID thing is going to push some of us. I'm a baby boomer too. Kathy is my sister, by the way, and she's a boomer.
Right.
So we started this thing going, I think our fellow boomers are taking too much risk. This COVID thing really is, I think, pushing it over the edge. Even though the markets have recently recovered, we're going to talk about whether we're going to see more recovery. I'm going to get my crystal ball out, and actually, I'm going to help you get your crystal ball out and see what you think. But in terms of this Lifepath thing, on the next slide.
Hey, Ron, let me ask you a question.
Sure.
On those statistics that you had, were those statistics that included people that had compromised conditions?
Yeah. Well, that's sort of the the controversy is how accurate are those numbers, and part of it is in the denominator of the ratio, number of people who contracted the disease. There's probably thousands, hundreds, a lot of people who got the disease and don't know it.
Right. Yeah.
So that probably overstates it. But second to that, we've seen the same things on the TV, that the doctors are being told that if there's any question, just call it COVID. So
right.
For the people in their 80s, a lot of those people probably would have passed away regardless of COVID or anything else, just because a lot of people in their 80s do pass away.
Mm-hmm. Or they go into the hospital with a non-COVID thing, and then they get a test and it's diagnosed as COVID.
Sure.
But that might not have been the real underlying issue why they were there. They could have been there for pneumonia or something else.
Absolutely. Yeah. So it's scary, but there's no doubt that it is affecting older people more than younger. There's no doubt that the mortality rate for young people is close to zero. Which, by the way, in the comparisons to the flu, the mortality rate for flu is 0.08%, so it's a little higher.
Yeah.
so for young people, the flu is a little worse than than COVID. But
yeah.
Anyway, it is scary times. So
okay.
This Lifepath idea basically is on the top of the graph here. We all save through life, and during our working life, hopefully we've accumulated enough so that when we stop saving and we start drawing down on those savings, we've got enough. And the critical thing in terms of retirement, the number one most critical thing is to save enough. So if you haven't done that, then it's problematic. You're going to have serious problems. But on the investment side of it, the sort of smart thing to do is, as your savings build, protect them. So on the bottom part of the chart, we're talking about the level of risk you take. And that's what we're showing you here is sort of what a target date fund does. As the savings grow, as you get older, it starts to protect those savings so that when the time comes that you're going to need them, they're there. And that sort of line in target date fund space is called the glide path. And then there's recent research that says when you're in retirement, when you're 5 to 10 years into retirement, what you ought to do is start retirement very, very safe. But then once you've been in long enough, you can start to go back into the capital markets to increase the likelihood that your savings will last a little bit longer. So you could take a little more risk. And we're going to talk about investing in retirement a little more later on in the show. But what I want to do now is just focus on COVID. And I'm going to offer you some of my opinions about, on the next slide, Kath, about what is likely to be the economic outcome. We pretty much know the health outcome, although I guess Fauci is testifying right now before Congress, so that's pretty interesting. But what I'm showing you here are bookends. So on the left is the ideal result. It won't be too bad. We'll get through it and life will be good and we'll all be happy. On the right-hand side is sort of the not so good scenario. And what you really need to think about for yourself, and I know none of us has a crystal ball, but think about in your heart, from what you're seeing, do you think the markets will recover to what they were?
No. I'm sorry, no. You asked my opinion.
Yeah, I don't either. And so the stock market was down 30% in just 1 month, the month ending March 20th. It's now come back a little over 30%, but the arithmetic in that, if you're down 30 and come back 30, you're still not whole. You need to come back around 40. So for the year to date, the stock market is down around 5%. So it's coming back, and all indications are maybe it'll continue, but I don't think so. And most people I'm reading don't think so either. And we'll talk maybe a little bit about why it's coming back, because the Fed dropping money from helicopters has had a lot to do with that. And that's sort of the second question. Will the government backstop all the issues? I think that's an impossible tax. And also this money that's being injected into the economy is likely to cause inflation. And we'll talk some more about that. then everyone is anxious to get this thing over, and ideally it would be over in 4 to 6 weeks. Given the fact that people are just going out and doing things they want to do and going crazy, staying at home, we probably will get more flare-ups and probably in the fall. Now, there's an article I want to talk about on the next slide, Kath, which goes into details. So this was in Financial Advisor magazine, and this fellow who wrote it this is a sort of soul searching for people who are investing to ask themselves what do they really see, and I'm showing you here. I think what's really going on in the stock market now is what I call the optimist falling from the skyscraper. So as he's falling down, you keep on hearing him say, "So far, so good." I personally think that's a little too optimistic.
Yeah.
So the questions are pretty intriguing. I'll just pose them to our viewers here and see what you think. Are you okay? Probably not. Do you see yourself being okay in 10 years? That's a reasonably good horizon. Now, the only thing about the 10-year time frame is for boomers, 10 years is maybe half of what they have left at best. For many, it's maybe all they have left in life. So they may not see this recovery. No, our horizons are much shorter than younger people. What should I do now? I am reading way too often now the pat answer that Wall Street puts out in all these situations is stay the course. Some even go to the extreme to buy the dip. You should buy more because now things are cheap. We have been telling our viewers, and I'm going to continue to tell you, that if you are the 60-40 mix, the risky mix that we think most boomers are, you should use this recent rebound to sell your equities and move to safety. And by safety, we don't mean, we've gotten some of this feedback, by the way. So if I move to high dividend stocks, or if I move to, value securities, or if I move to consumer staples, those are still risky. And the things people are writing about now is interesting because cash, like treasury bills and treasury inflation protected securities, those are the safe place. And all of a sudden, more articles are coming out about using cash to control risk. By the way, one of the things we talked about in our third show, in our third show, was the Nobel Prize was won by Dr. William F. Sharpe for what's called the capital asset pricing model. And what he showed there is when you want to control your risk, reduce your risk, you can move more to safer assets, to bonds and things with less volatility. But the safer thing to do is to take a well-diversified portfolio and add cash to that. So if you take our advice, you can keep some of your stocks and bonds. That's fine, but move more into very safe assets. So, Kathy, can we go back to that slide, please?
Yep.
Thanks. So, our advice is not stay the course, and certainly and we even talk about this too. So, you are probably invested in your 401k and or your individual retirement account, your IRA. If in your 401k you are in a target date fund, you are taking too much risk right now. Target date funds for people near retirement are very risky, so you need to get out. If you're in your individual retirement account, you're probably about 60% in equities, so you need to lower that. So the next question is, when will markets return to normal? And there's a lot of conversation about the shape of the recovery. The hope was that it would be V-shaped. And that certainly looked like it was going to be the case because the markets came off of the March 20 low, just skyrocketing up. But lately, it's just been vacillating. So in terms of the shape, it's almost like a check mark with a little blip on the end of it. The U-shaped recovery was that we're going to stick down at the bottom for a long time. That's probably not going to happen. The V is not going to happen. The W could happen. So what a lot of people are saying is this rally we're seeing is been seen many times before in recessions and market crashes. It's called a fool's rally. And I think some of that's being propelled by the Fed intervention. So I'm going to be sticking on this quite a bit, but when the Fed pours money into the economy, it's got to go somewhere. And if it's not being spent entirely on food and essentials, I think a fair amount of it is being spent on food and essentials. The other place it can go is investments. So what we're seeing here really, I think, is a inflation, actually, in the stock and bond markets. How long that can go on, I don't know, but it sort of leads itself to thinking about a W. The L is not going to happen. It's too late for that. We've had the bounce back. So in terms of those 4 letters that people are thinking about, I think the W is, of the 4, the more likely. And policy effects on the economy. The fiscal effect is likely to be, so what we're doing now is the Fed is putting officially $3 trillion, but probably $5 trillion into the economy. There's already $5 trillion there for quantitative easing. Our gross domestic product is just a little over $20 trillion. So they're pouring $10 trillion into a $20 trillion economy. And just the other number to keep in mind is before the Fed was pumping another $5 trillion in there, our debt was equal to the $20 trillion GDP. So 100% of GDP, now it's going to go above 100%. So something's got to happen. And fiscally, that means more taxes. It means curtailed spending. And the other thing about the monetary policy is it's going to spill into politics in this election year. And it's going to be interesting to see how Trump's handling it. We're already seeing him position himself, basically saying, if I'm not reelected, things are really going to get bad. I don't know what any president can do about this mess. It's just so, this stuff is already bad. Okay, so the next thing, long-term medical, economic, and political consequences. I guess it is touched on the political. The medical consequences, if I'm reading about anything good, is now we know that we're not prepared for a pandemic, and I think getting a vaccine and being more prepared, that's all good, but the economic consequences are I mean we've had 15 to 20% cut in GDP. Unemployment's running at 15%, probably going to 20. Corporate profits are down 15 to 20%. So there's a lot to recover from. And then what should I be doing differently going forward? I'll just reiterate for boomers, take some risk off the table. You came into this mess with too much risk. And now COVID has really made things much worse. So from here, Kathy, I'm going to talk about target date funds, just because they're a good model for lifespan investing. So that's on the next slide. Okay, that's what I was going to ask. Is that the next slide? Yeah. Okay. Yeah. So this is my patented target date fund design. Pretty simplified. So the equities are stocks and real estate and commodities and precious metals, and the bonds are global bonds, and then cash is treasury bills and treasury inflation protected securities. And my design starts out fairly aggressive for young people. So the bottom scale is years to retirement. So people with 40 years to retirement, young people are about 90% in equities. And then when they get down to about 15, 16 years to retirement, where that line is, I start to move to defend. And that path is curvilinear. And the arithmetic in there is financial engineering that is designed to preserve the current value of the assets. Now, the reason I'm warning you about if you're in a target date fund to get out is the industry is nowhere like my design. Well, actually, they're like it until 16 years to the target date. And then from that point forward, moving from roughly a 50-year-old to a 65-year-old, the industry ends up at about 60-40, 60% equities, 40% in bonds. And the other key thing about that 40% is much of that is risky. So the industry is about 70 to 80% risky assets for our fellow boomers. Very, very risky. And in our third episode, we talked about a evolution in investment consulting, and it's on the next slide, Kath. And so it was basically an epiphany, and it really was, and it has to do with target date funds.
Yeah.
So in this graph on the right, everyone is using models.
The cookie cutter.
The cookie cutter investment models. What I'm showing here is what's called an efficient frontier. And what it's an envelope. So for any given level of risk, the most return you can earn is on that red curve. And then the numbers there, portfolio number one, model number one is the most risky. Portfolio number two is the next less risky. 3 is in the middle. And 3 is 60-40. That's become a very popular mix. 4 is more conservative, and 5 is about as conservative as you can get. So what lifespan investing in target date funds basically said is most of the time you'd want to manage to your objective. So you would have a return you need, like a required return. And the advisor or the money manager would map you into one of these cookie cutter models, and it'll most likely be 60-40. The notion of you can't afford that risk is caked in the ideal target date fund. And ideally it would say at your age, where you are, your objective needs to be to protect your assets. And you might have other things you like to do. I mean, we all like to buy a yacht, we all like to buy a mansion. But at some stage, the advisor needs to draw a line and say, you're not going anywhere more risky than that line. Now, the other thing that's come out in terms of benefits from target date funds, there have been surveys done of consultants and plan participants. And the major question is, what is too much risk? What is excessive risk? And the answer to that question in these surveys has been, if you are in this risk zone, the 5 to 10 years before and after retirement, and you lose more than 10% of your savings, that's excessive. So now we have a number that we can wrap our arms around. And that exposure is not 60-40, it's actually something less than 20% in risky assets. So 60-40 is way too risky. And the other thing that just reminds you of the old rule of thumb was don't take any more risk than 100 minus your age. So if you're 65, you shouldn't be any more than 35%. I would say no more than 35% risky assets, and expand risky assets to include risky bonds. So stocks, real estate, bonds, and so on are risky. So again, I'm hammering on the fact that you need to be in touch with how much risk you're taking. And if I'm right and you're 60-40, you need to get safer. Now, a reminder of that just happened on the next slide, Kath. And the press has really picked up on this. For the month ending March 20th of this year, it's only a little while ago, the S&P, the stock market was down about 30%. Target date funds designed for people who are retiring this year in 2020, you can see the numbers. The most conservative was down 13%. The most aggressive, T. Rowe Price, was down 22.79%. I manage a target date fund called the Smart Target Date Fund Index that follows my patented Safe Line glide path. That was down 2%. So we just got a reminder. It's maybe fallen a little bit behind in the mirror because markets are recovered. But this is like a big warning shot. And if you want to ignore it, I think you do so at your own peril. The last warning shot prior to that was in 2008. It's on the next slide, Kath. And in 2008, the major target date funds, by the way, Fidelity, Vanguard, and T. Rowe Price manage 70% of the $2.5 trillion in target date funds. So it's an oligopoly. And all three of those were down more than 30%, blew way past the 10% threshold that says excessive risk.
Wow.
Yeah. My target date fund, the smart target date funds, were down 8% in that time span. By the way, it's not just 2008. The decline started in November of 2007 and kept on going until February of 2009. So that's the time period we're talking about here. So my design is less than 20% risky. My glide path is called the safe landing glide path. The rest of the industry is 60% in equities, but most of what's left is risky assets. So more than 75% risky assets. Now, I guess I'm sort of telling you that as a commercial, but on the next slide, this can't be much of a commercial for a reason I'm going to tell you. If you like to be in a target date fund that is safe, you can't do it. Because my smart funds are available on just the 401k plans. So your 401k plan probably does not have my smart funds. You might want to talk to your employer about looking at it. But so you really can't move to smart right now. Now, you'd be smart to do that. But the other problem with target date funds is very well known, and it's that they are one size fits all. So there's incentives here for you to take back control. And on the next slide, we'll give you sort of a framework for you to do that. And in essence, what you'd be doing is building your own target date portfolio. So the notion of Lifepath investing is good. And we show you here the typical target date fund, typical Lifepath. And its problem is that right now you would be at least 55% in equities. Bottom line, you'd be about 75% in risky assets. And what we would say to you is take control, do your own target date portfolio. But at this stage in your life, you should be less than 20%. We have a B prime here, that's the 10%. And then stay safe for the first 5 to 10 years in retirement. Or what would probably make sense, although not many people are doing this, is buy annuities. There's also these guaranteed minimum withdrawal plans that are sort of like annuities, but have a little more control. So do something special in retirement. Now, this discipline is something interesting we talked about in our very first baby boomer show, which we show on the next slide, Kath. So our very first show was about do-it-yourself investing. Mm-hmm. Remember that?
Yeah, I do.
It seems so long ago.
Yeah.
and we have an ebook that, if you're interested, is available on the website. But the key thing here is that the 4 pillars are establishing your goals, knowing what you want to achieve with your assets, taking appropriate risk to achieve those goals, and then the next 2 things are just motherhood and apple pie. The more diversification, the better, because it's the only free lunch in investing. You get the best return for the risk, and any penny that you can save is a penny in your pocket. So try to control the costs. So the key thing for boomers is that the number one goal is to protect your assets. Don't lose your savings. And that really means that you need to really lower your risk. And risk management is not market timing. We're not saying to you, the sky is falling and everything's going to be really crummy. But what we said on our second show was that there are serious dangers lingering out there. And that part of it is akin to market timing. So I'll confess to, in a way, being a market timer, but what I'm really saying to you is that sometime in this decade, in the 20s, one of these bad things is going to happen. Actually, one of them already has happened. So in our second baby boomer show, we talked about the threats, and that was 2 weeks before COVID was called a pandemic. So on the next slide, Kath, let me remind our listeners. By the way, I'm sorry, I want to go through. So this is
You're Mad Guy, Mad Magazine. Yeah,
Yeah,
I remember.
I remember. I don't know how many of our viewers remember. I used to love Mad Magazine. I thought it
I
was
know. I
great.
remember you had it all the time.
Yeah,
Yeah,
I had a stack of them.
yeah.
Um, so I think COVID is sort of the match that lit the threats tinder. So it just sort of awakened us to these threats are out there. And then on the next slide, Kath, I want to talk about specifically the threats we talked about in the second show. And I want to encourage folks. So we have a YouTube channel and a Facebook channel. All of the past episodes are available. So any of these topics you can go back to, and we really went into depth on these threats. COVID-19 was one of them. There has been a stock and bond market bubble that has been in place. A large part of why the stock market went up over the last decade has to do with quantitative easing. And I sort of alluded to it earlier, but I'll say it now. There's been people who have said, so the Fed put $4 to $5 trillion into the economy in quantitative easing. We got no inflation. That's just unheard of. I mean, the whole idea about inflation is too many dollars chasing too few goods. So how come we didn't get inflation? And the answer is there's no velocity. Well, that money had to go somewhere. Velocity means the money didn't circulate. That money went into the markets. It went into stocks and bonds. So
Really?
that's we're seeing those high prices because the people who got that money invested it. And not only that, but the corporations there's been these buybacks. So they've been buying back their own stocks. So we're seeing a very inflated stock and bond market before COVID even happened. And that when bubbles burst, it's never pretty. So I think that's a real threat. The other real threat is it's not just America that's broke. The whole world is broke. And it might surprise people to know that before this new injection of another $5 trillion, the per capita debt was $200,000. So, Kathy, you may want to put yours in now just to help the economy.
Put what? Put mine in. Oh, okay, yeah.
Yeah.
Okay.
Because every little bit helps.
Yeah. Okay.
Thank you.
You're welcome. Well, then will you do the same?
Yeah, sure. We're all in. Yeah.
Okay. I was focusing on that Social Security and Medicare going bankrupt.
We're going to do that.
Oh, gosh.
I'll touch down there. So North Korea and Iran have been there. Nuclear threats have been around forever. I guess Russia's not so much anymore, but it's hasn't gone away. Trade wars, certainly with China and sanctions and so on with Europe. Some of that's probably good. This recent bout has certainly made us sort of almost anti-China, I think, and I think that's not a good thing. So politically, maybe it's good. From an economic point of view, not so good. Hyperinflation is something that people have not worried about because we haven't had even a hint of real inflation for a long, long time. But this recent dose of another $5 trillion. The interesting thing of one of the things we talked about in episode 2 was who's holding the U.S. debt. Well, a lot of foreign money is being held. So China and Japan each hold about $1 trillion each. I think it's $1 trillion. I don't know. Is this 20? Anyway, much of that money is being held by the Federal Reserve. And we said on that show, so if we keep on incurring this debt, who's going to buy our debt? And I didn't realize it back then, but who's buying it now? So we're not going back to China and Japan and saying, hold more of our debt. The Federal Reserve is buying it. So just think about that.
Wow. The
Treasury's issuing it. The Federal Reserve is buying it. And it's like, there was a word voodoo economics. It didn't apply to this, but it sure feels like bad magic. It feels like really bad magic. So it hurts my hair to try to think about how that works.
Yeah, mine too.
So the other threats are very strike home right away. Medicare will technically be bankrupt in about 6 years, 2026. Its liability So our total debt's around $25 trillion, the reported debt. The liability for Medicare is $47 trillion. So almost twice the official debt. Social Security, for the first year ever, 2018 was the first year where the money coming in was not sufficient to pay out. So it's first time that the system had to dig into new money. It's forecast to go bankrupt by 2034, so there's more time there. Its present value is about the same as the national debt. It's about $27 trillion. So if that doesn't scare folks, I don't know.
Well, let me ask you this, Ron. If that is the case, then the people that are on Social Security, they're continuing to pay into it with the idea that they're going to get a return on it. Where is that money going? That's going into Social Security. If they're never going.
Yeah, it goes into an account, and it's sort of part of the national debt. We owe that to ourselves. But what's first of all, it's got to happen that Congress will do something, but I think people currently on Social Security is because there's 78 million baby boomers, most of them on Social Security. They vote. So I don't think people on this call will see their benefits lowered. They may see more of their benefit getting taxed. We will almost certainly see a needs test. Some people watching the show don't need Social Security. And even though they paid into it and it's fair they get something out. But things are going to change. The Social Security age will get older and older and older. The level of benefits will go down. Probably the cost of living adjustments will change. A lot of things will change, but it's still a huge liability and it's being ignored. So I just throw that out there for people who like to not sleep at night. There's the
Yeah, but it's just like right now, all of a sudden we had the country, everything closed down and people didn't have their income coming in. The same kind of thing could happen to a senior. All of a sudden you don't have your Social Security. What do you do? Where do you go? How do you eat? How do you pay your bills? How do you do all these things? So that's a very scary, scary situation.
Yeah. Well, this whole thing could ripple. And part of the reason we're reviewing episode 2 is now we got one of them. And just think of how terrible it would be if another one of those falls.
Yeah.
While this COVID thing is going on. Or maybe 2 of the things fall. Who knows?
Oh, gosh.
So something will happen in the next decade. COVID is not the end of the bad things that could happen.
Oh, gosh.
So this is a good society, Kath. You're right. So one of the famous things is John Templeton said, what people always say in these situations is this time it's different. So this time it is different. And here's how. And there's other things too, but we've never had 78 million baby boomers in the process of moving from working life to retirement. So when 2008 happened, most of the boomers were not in the risk zone. And that was the good news. So most of the boomers had time to recover from 2008, and hopefully they all did. Now that they're in this risk zone, the mathematics and the reality is that if they lose money during this 5 to 10 years that they're transitioning from working life to retirement, they will be spending down the reduced amount of money. So if things do recover, they'll be recovering with less money. Many of them will take the loss and just get out of the markets altogether. Before I even go too much further, I thought, you want to do that before the loss, not after the loss.
Yeah.
So you need to move now. The other thing that's never happened before, as far as I know, is the boomers will be transferring $65 trillion of their wealth to the next generation. So a lot of money is moving. Third thing is we've never, ever had negative interest rates in this country. Other countries have had, Japan, for example, for a while. But the craziness of that, think about it, that you're going to pay someone to take your money.
Wow.
Is that crazy or what?
Yeah.
The other thing that I know has never happened is we've never seen so much money being poured into the economy as a stimulus ever. And Warren Buffett, I saw him on an interview maybe 3 or 4 years ago, and they asked him what he thought was going to be the outcome of quantitative easing. Now we've got a double whammy. We got quantitative easing and the stimulus. And he said it's the biggest experiment that has ever been made, and it's huge, and no one knows the outcome, but it's definitely dangerous. So I guess many of us will live long enough to see it. We've never, ever had energy futures trading at a negative price. I don't know if people on this call saw that, but
yeah,
the oil miners, the oil companies would pay you $33 a barrel to take their oil. Duh.
Yeah.
Crazy. And then the Fed has actually now announced that this is going to go beyond just buying mortgages and so on. It's going to step in if it needs to buoy up the prices of exchange traded funds, stock and bond. They're like mutual funds, but they trade like individual stocks. So we give this warning every show, but I'm going to do it again, Kath. This is sort of our wrap up.
Okay. Can I just add something? What we've never seen is food being destroyed because the food chains are not being run properly. They're throwing away all this milk and eggs and everything, and it's all screwed up.
Definitely. Distribution channels are screwed up. We bought a whole cow yesterday just to make sure we're covered on meat.
Did you really?
No.
Oh, okay. I don't know.
we went out and bought a big knife, so well.
Hey, listen, a lot of people buy whole cows. They do.
Yeah, I know you can. Yeah.
Okay.
So our message every show is to get help, and I want to reinforce something for you. You probably have an advisor, and you should certainly trust that advisor and talk to him. But if you wanted some sort of help on whether that advisor is giving you the best advice you can get, watch episode 3 of our show. And it's the 70-year history of investment consulting and all the theories that have gotten Nobel Prizes and everything that's wrapped around cookie cutter models and turnkey asset management platforms. You really need to understand why you're getting the advice you're getting. So we've got that help for you. Then if you want to do it yourself, we have a website that's called 8-Stage Robo. If you Google that, that will top of the list. So there, what you can do is tell our website your situation, and it will show you sort of a sample portfolio that you could actually buy, but it's not so much intended for you to buy as to give you sort of guidance on how much in equities, how much in bonds, and so on. And there's some free ebooks out there about the pillars of smart investing and bad gambles. If you think you'd like to change advisors, we have another site for you. It's called Lifepath Wealth Management. And there we do help you basically build your own target date portfolios. And we use a consulting firm called Janney Montgomery Scott. And there's plenty of self-help books on the website as well. So we're offering a lot of things you can do. Please continue to watch our Baby Boomer Investing Show. The next one we're going to do is going to be on inflation. And the reason I want to talk about inflation is we're advising you to move into safe assets like cash and Treasury inflation protected securities. If we get serious inflation, that cash is not going to help you much at all. So we're going to talk a little bit more about how you might best position a safe portfolio to also guard against the ravages of inflation. Now, inflation will eat away at your savings. So if you have $1 million saved and we get serious inflation, that might buy I don't know, for sake of argument, $500,000 worth of food and whatever else you need. So you can also contact me. My email address is on that slide. It's Kath, you want to show it? It's Ron.
Yeah, I had changed slides. Sorry.
Oh, okay. It's Ron at ppca-inc.com. So the next slide is just wishing you all well. This is all about getting our viewers the good life, and America's been the right place for the good life, but you need to make the right decisions. And at this stage in your life, your goal for investing really should be to not lose what you saved. So, and that's it. Thank you for watching.
Let me ask you, Ron, why do you think that a baby boomer would not make a move? Is it laziness, or they just don't want to take the time to do it, or they just don't think it's going to happen to them, or they figure, well, they're pretty confident with their advisor and they would take care of it?
I think mostly the last.
Okay.
So the wealthier people are using advisors, and the people on this call who are using advisor need to watch episode 3. So there are good advisors, and episode 3 doesn't say all advisors are bad. It just gives you the wherewithal to understand the advice that you're getting and where it's coming from. And this epiphany about what's underneath target date funds and having risk capacity override the normal things that advisors would do. And what they normally do is work with you, establish your goals, find an asset allocation to achieve those goals. They need to be telling you your goal right now, it needs to be protect your assets. The mansion is fine, the boat is fine, all that is good stuff.
Yeah.
But for now, you need to protect your assets. Also, there are millions of people in target date funds. And a target date fund is mostly for people who don't have the financial education to make their own decisions. So their financial literacy is very low. I don't think those people are on this call.
Mm-hmm.
But if they are, if they are, they need to get out of their target date fund, because it's not protecting them. It didn't in 2008. It didn't in this recent decline in the stock market. Except for the smart funds, which are probably not on their platform. So
maybe what a baby boomer should do then is invite their financial advisor to watch episode 3, so that they can get an idea of some of the things that are available that they not that we're saying they don't know, but maybe they don't know.
I don't think they know. No, okay. I think they know target date funds are a big deal, that they've really gotten popular. But I don't think the disciplines in target date funds have made their way to the individual investor. So it's pretty much just an institutional idea right now. And
okay,
I think it will evolve.
So then the boomers really have the opportunity to help their financial advisors get educated, right? In essence.
As you're saying that, I'm thinking, I don't know how many people would feel comfortable doing that, but yeah, I suppose they could.
Hey, if I had a financial advisor, I would say, did you watch the Baby Boomer Investing Show on financial advisors and target date funds? I would do that.
Yeah, good.
And
that's a good idea.
I would send them a link.
That's a good idea.
Yeah,
sure.
Okay.
Can't hurt. Yeah.
Okay. Well, that's the show. Thank you, everyone. We'll see you in 2 weeks. Got
Talking about
else?
Inflation. Inflation in 2 weeks. And then in 2 weeks after that, we're going to talk about getting a job.
A job. Oh, okay.
Believe it or not, there's a guy. I think his thing on LinkedIn is called Get a Job. But anyway, he helps older people find work.
Oh, okay.
Yeah. So I think it'll be interesting.
Yeah. It sure will.
We're not all washed up just because we're old.
Yeah. Exactly. Well, the problem is, Ron, when you get older, as you know, you got all these things that you want to get done.
Sure.
But unfortunately, you wake up and maybe about a third of them get done because either you're too tired or you just can't get it done. It just is. So I think the lesson, at least for me, because I fall into that category, is don't put so much on my list. One thing a day, maybe. One thing a day. And then if I get it done, yay. So
there's somebody who told me the thing you want to do, the first thing you get up, is make your bed, because then you've accomplished something, no matter what the rest of the day is.
And that's funny. That's exactly what I do before I even go to
Me
the
too.
bathroom.
Yeah, me too.
I make my bed. Yeah, absolutely. Yeah.
Accomplished. Done.
Bada bing, bada boom. Done.
Yep. There you go.
Okay. All right, everyone. Thanks so
Thanks,
much
guys.
for watching. Bye.